Hello and welcome to the Tax Roundup for November. And what a huge month it's been. Inside this month, we're taking a look at the resurrection of the amendments to prevent non-residents from accessing the main residence exemption. Now, you remember this was announced in a federal budget a few years ago. Legislation was introduced into Parliament, but it was stymied. Since then, we've had an election and a recomposition of Parliament, and the government is giving it another go with a revised version of that legislation. We're also going to take a look at a case that went before the High Court dealing with the tax treatment of payments to acquire gaming machine entitlements. Now, this case went before the Federal Court and now the High Court has overturned that decision. But first up, Michael Carruthers is going to take you through that very complex legislation that passed through Parliament dealing with deductions for vacant land. Across to you, Michael.
Now, this month we've seen legislation pass through Parliament with a bill that contains quite a number of tax-related changes. But the big item that I want to discuss right now is the changes to deductions for holding costs on vacant land. Now, this was a reasonably controversial measure in some respects because there seemed to be some pretty major flaws in the way that the legislation was initially drafted. And it meant that there were going to be people who were genuinely using land to earn assessable income in a commercial way, and they would miss out on all these deductions for holding costs. Now, what's happened is that some amendments have been made to the bill prior to it passing through Parliament. And those amendments address a lot of the really major concerns that people had around the impact that this bill would have had on people who were doing things in a commercial way. Now, that doesn't mean that the clients won't have issues under these changes though. Basically what the rules say is that if you incur holding costs on a vacant land, so land that doesn't have a substantial structure on it, you miss out on those deductions from 1 July 2019 unless you fall within the scope of very specific exceptions that are contained in the legislation. Now, these rules are really hard to understand. At a high level, it's kind of possible to get where the government's coming from. What they were concerned about was that someone would buy a block of land, would claim that it would be used for some income producing or business project in future. But the issue was, well, it's really hard to determine what that intention really was, how long is too long. There's some real practical issues around that. The other area that the government had some real concerns about was people who buy land with the intention of building a rental property. Now, there has been guidance for many years suggesting that during that construction or development period, you can claim a deduction for holding costs as long as certain conditions are met. It's these people who are going to be majorly impacted by the passage of this legislation. So if you buy land, even if you are genuinely building a rental property on that land and you're going to rent it out as soon as the work is finished and you're doing it as fast as you possibly can, from 1 July 2019, regardless of when you bought the land, the holding costs incurred from 1 July 19 onwards will cease to be deductible. What will happen is instead they'll be included in the cost base of the property, which might help you reduce the capital gain on future sale. Now, the other major carve-out, I guess, from these rules is where the land is being used in certain business activities. And this is where a lot of the concerns were. Some business activities originally looked like they would qualify for this exception and some didn't. So the government has fixed this up to a large extent. If the land is genuinely being used in a primary production business, then it's probably going to be okay. If the land is being rented on an arm's length basis for someone to use it in a business, then it's probably going to be okay. But there are exceptions to those exceptions. For example, where there is a residential dwelling on the land, that might mean you fall outside the scope of the exception. It might then impact on the interest and other holding cost deductions you can claim. Now, as I said, these rules are complex. They're quite difficult to work your way through, and a lot of the concepts that are used in the legislation are not familiar concepts. They haven't necessarily drawn on existing concepts that we're used to using. So we really will need to work through this quite carefully to get our heads around which clients might be affected and to the extent to which they are affected. For example, in some cases, there will need to be an apportionment done. You might be able to claim holding costs for an area of the land that is used in a certain way, but that might not necessarily mean you can claim deductions for the entire property. You might miss out on a portion of the interest or other holding costs. It's that process that is going to be quite difficult to work through for some clients. So the legislation has passed, it's here. There have been some last-minute amendments that make it less harsh than it would otherwise have been, but we will still need to look at this. Any clients who claim holding costs relating to land or property, we really do need to have a look at their circumstances and make sure that from 1 July 2019 that either they're not affected or we understand exactly how they are affected and what impact that will have on their tax position.
Knowledge Shop is hosting a special webinar dealing with these very complex rules to do with the deductions for vacant land on the 9th of December, so don't miss that one. And now across to Michael for those amendments to prevent non-residents from accessing the main residence exemption.
The other bit of legislation we've seen come through and be reintroduced into Parliament has been the bill that will basically prevent non-resident taxpayers from accessing the main residence exemption. Now, this one is pretty much back from the dead. We saw a bill introduced on this topic a little while back, didn't really go anywhere, election was called and the bill lapsed, and it really wasn't clear what was going to happen. Did the government plan to reintroduce this or not? Well, the short answer is it looks like yes, because the government has reintroduced this, but with some minor amendments being made. Just really high level. What this bill basically says is that if you sell a property and you are a non-resident at the time of the CGT event, we're talking about a non-resident for tax purposes, then you will no longer be able to access the main residence exemption for CGT purposes. You don't get a full exemption and you don't get a partial exemption. There is no exemption available at all in relation to the sale of that property. So it is your residency status for tax purposes at the time of the CGT event which will be crucial. So what it means is that if you have someone who has left Australia and become a non-resident for tax purposes, and they then have a CGT event that happens to their former home while they're a non-resident, then they don't get any exemption under the main residence rules, regardless of whether they're a resident of Australia for some or most of their ownership period. However, if that person hangs on to the property, comes back to Australia, becomes a tax resident again, and then sells the property the next day, they could potentially apply a complete and full exemption from CGT, or maybe obtain a partial exemption. So residency status at the time of the event is going to be the crucial thing. Now, this isn't law yet. This is a bill that's been reintroduced to Parliament. It's not law. We're going to have to wait and see what actually happens with this. Just to cover a couple of the changes to this bill compared to the previous version. First of all, there is a proposal to have, I guess, a carve-out from these new rules for situations where someone has been a non-resident for no more than 6 years and certain significant life events occur to them or certain family members within that 6-year period. So basically what the government is saying is that even though you're a non-resident when you sell the property, you can still apply the main residence exemption if you have sold the property while you're a non-resident and certain things have happened to you or your family while you're a non-resident. That would include serious medical issues that have been suffered by you or a spouse or certain children. It could be the death of your spouse or child. It could be a marriage or relationship breakdown scenario as well, where one of those things has happened, you've been a non-resident for less than 6 years, you could potentially apply the main residence exemption. But in practical terms, that's going to be limited to a very small group of people, you would think. The other thing that changes here is an extension of the previously announced transitional period. Basically what the government is saying now is that if you held your property or your interest in the property at budget night 2017, so 9 May 2017, and you continuously hold that interest until you sell and the CGT event happens on or before 30 June 2020, then you can basically apply the rules as they stand at the moment. And you may qualify for a full or maybe partial exemption. So where people are non-residents, they do potentially have an opportunity to sell their property prior to 30 June 2020 and still take advantage of the main residence exemption. However, of course, just be a bit careful when you're talking to clients because this isn't yet law, so just need to be mindful of that when you're having those conversations with clients who might be non-residents now or might be considering leaving the country at some point in the near future. The other thing to mention briefly is that these rules can impact on inherited properties as well, where the deceased individual was non-resident or maybe beneficiaries of the estate are non-residents. These proposed changes could have in some ways a fairly complex impact on how the CGT rules work as well. Now, missing out on the main residence exemption as a non-resident isn't the end of your problems, because as a non-resident you may not get the full 50% CGT discount. You're not going to get a full or partial exemption under the main residence rules anymore. The cost-based reset rules that sometimes apply to reset the cost base of a property to market value when you start renting it out are probably not going to apply to you either. And from a cash flow point of view, you're probably now in the scope of the foreign resident capital gains tax provisions as well. So as a non-resident, with the passage of these rules, if it happens, there's quite a number of flow-on impacts that will potentially impact on tax and cash position of those non-resident clients. So something to be a bit careful about, something to, again, be on the lookout for in conversations and advice you're doing for clients. And we'll just have to keep an eye on the progress of this bill to see whether it does pass and whether any further amendments are made prior to any legislation being enacted.
Parliament sits again in November, so keep an eye out on Knowledge Shop's Twitter feed and we'll let you know as soon as anything occurs on those amendments to the main residence exemption. And for members of Knowledge Shop, we'll also produce a guide for your clients to make sure that they know what their obligations are and what the issues are if this law does in fact pass Parliament. But now across to that case before the High Court, dealing with the tax treatment of payments to acquire gaming machine entitlements.
Now, we don't see that many High Court cases in the tax world, but we have seen one recently, and that's the decision of the High Court in the Sharpcan case. Now, this was due to an appeal from a decision in the full federal court, and basically the High Court has said that the full federal court got it wrong, and in this case, certain payments that the taxpayer had made should actually be dealt with on capital account rather than revenue account. Now, a brief history of what happened in this case was the taxpayer operated a hotel venue, and at a certain point in time, they decided to commit to spending a significant amount of money securing some gaming machine entitlements. Now, the issue then was, should those payments be dealt with on revenue account and be deductible up front, or dealt with on capital account and be dealt with quite differently? Now, as I mentioned earlier, the previous decision from the full federal court basically held that the payments were on revenue account. Now, interestingly, the court had said that there were a number of features to this which would normally indicate capital account treatment. But the federal court said that on balance should be dealt with on revenue account, primarily because these payments were made to basically ensure that the business could continue. The viability of the business as a going concern would be jeopardised if it wasn't able to secure these entitlements. Now, the High Court looked at this quite differently. The High Court said quite simply, what is the purpose of paying this money? And the High Court said the purpose of paying the money was to secure these entitlements, which would provide an enduring benefit to the business. So we had this large amount of money being outlaid in order to secure something that would provide an ongoing benefit to the business. And the High Court said that that suggests capital account treatment, and you can't claim a deduction for that on revenue account. So we have come across a number of people since the federal court decision who have been looking at the federal court decision as maybe being some precedent and some authority for being able to argue revenue account treatment for significant amounts paid in relation to their business. Where you have done that or kind of gone down that path, you need to make sure that that's revised and revisited in light of this High Court decision. In some ways, my personal view is that this comes back to what the answer probably should have always been. It kind of always felt like capital payments have been made in this case. And the High Court has basically confirmed that this lump sum amount, this large amount, albeit maybe paid over time, was to secure a capital asset for an enduring benefit of the business. Therefore, we go back to those basic principles and factors that we look at in determining capital revenue account treatment.
And that's the tax roundup for this month. There is so much change this year and so much more to come. It feels like we're constantly dealing with legislation that's in flux at the moment, and trying to apply those laws and practice is more difficult than ever. And this is the role that Knowledge Shop plays for its members. We try and keep you up to date through the help desk, our standard work papers, through alerts and updates and guidance that we can provide, and also our training as well. If your firm is not a member of Knowledge Shop as yet and you'd like to know more about it, then give the team a call on 1800 800 232 or take a look at the website knowledgeshop.com.au. But until then, we'll look forward to seeing you next month.